Hi, everyone. Okay, so welcome to the podcast. I reached out to Michael because I work with a lot of businesses who are really struggling with cash flow. And it's quite a normal thing that when you get to a point where there's debt, which is so high, then you should get referred to an insolvency practitioner. And this is what Michael Goldstein is here to speak to me about. He is a registered licensed insolvency practitioner with RG Insolvency, years and years of experience. And we're going to have a discussion about what is the process when a business gets into debt where they can't handle and they need to be referred to someone like Michael, an insolvency practitioner, and what are the routes available. So Michael, I hand over to you, and let me hear from the beginning and end. So what's the whole journey?
Thank you, Robert. Really appreciate the introduction. So, where you have a director who's a director of a limited company, directors have got to be very careful because while they enjoy limited liability, it's not a blank check. And furthermore, is there too much background noise, by the way?
There's no background noise. It's fine.
Yeah, okay. So they've got to be very careful because although they enjoy limited liability, it's not a blank check. The reason for this is one of the things that directors are exposed to is fiduciary duty. These are their duties as directors of limited companies. Now, one of the duties we call wrongful trading. And wrongful trading is where a director knows or should know that the company is insolvent and it can't continue trading, but they carry on trading anyway. And the danger there is that the director is held personally liable for any increase in liabilities, in company liabilities. So effectively, it pierces the veil of limited liabilities. So often what will happen is we have companies, directors referred to us by their accountants or their lawyers, where the professional is concerned that if the director carries on trading, he will have negative exposure.
Let's talk about, if it's okay, let's just talk about an example, just to bring it down to kind of the real world. You've got a business, and let's say they're selling cars, right? For the sake of argument, and what they're doing, they're borrowing a lot of money in order to get stock. Is that is common sense scenario? They're trying to
Hmm.
go on, carry on. How
Yeah.
does that
So
unravel?
So in your example, you've got a business. They are buying cars and they're selling cars, and they've got a lot of money tied up. Let's assume, for example, that they've managed to fall behind with payment on VAT or corporation tax. They may have a situation where they haven't paid the landlord, or maybe even they haven't paid some of their suppliers. They've got increasing creditor pressure, so they owe money, and every month the amount that they owe the creditors increases and increases and increases, and there's no sign of this. So there are two tests for insolvency. The first being the balance sheet test, where the company is insolvent if the liabilities exceed the assets, and the
Like the
second
amount
being the
that they
cash.
owe, just to interrupt you for a second, I know that some of our guys wouldn't have a clue what a balance sheet is. So if the liability means the amount of money they owe people exceeds the amount of money that they actually have in the business, is that what you mean?
Correct. Yes,
Right.
absolutely. So in that situation, the company would be balance sheet insolvent. And the other test for insolvency is what we call cash flow insolvency, which is where the company is unable to pay their debts as they fall due. Now, I'm sure you will have seen that most companies where they have an issue, it's on the balance of cash flow. It's a cash flow issue. So they just run out of road. There may be they know they need to make the payment at the end of the month, and there's just too many days. There's enough cash, but just too many days between now and the end of the month when they're going to get the money in. So in a situation like that, the director should know that there's an issue. And often we see warning signs. So, what are the warning signs? First warning sign is they start getting letters of demand from revenue. So, the letters start off plain and then they got green borders and then they get red borders. And at that point, it's really important that they take advice. It may be that they have CCJs or statutory demands issued against them, or even bailiffs turning up at the premises, unhappy creditors, people they owe money to that phone them up and demand payment, and they know they can't pay them. At this point, they really need to speak to their accountant and take more advice because they very often out of their depth. So what happens is I often get called in at that point and I get asked what for advice. And people try to complicate insolvency. The truth of the matter is, insolvency is actually really, really simple. So what I look at is I look at what are the assets in the company, what are the liabilities, how pressing are the liabilities, what is the experience of the directors and what do the directors want to do? Because sometimes directors will say, you know what, I've had enough. I've been dealing with this for too long. I want to walk away and go get a job somewhere, or I want to retire. That's fine. Um, Sometimes they'll say, actually, we face this issue because of something that's happened out of our control, even within our control. Maybe the director made a mistake and signed a lease on a big building where actually they only need a portion of the building. And as a result, they've had to pay rent on all of the building, but the business just hasn't expanded at the rate that they thought they would, leaving them with massive overheads. So that's quite common. And very basically, what we would do is we'd come in, we'd understand the situation, we'd understand where the pressure points are. We'd see alongside the accountant, first of all, if there are non-statutory insolvency options available.
What does that
It
mean?
may be that you can assist them with better cash flow management, Robert. You can give them proper management accounts, come in and really help them understand where the drains are. My old boss used to say that whenever you run a bath, the first thing you got to do is put the plug in. And he's absolutely right. It may well be that there are things that are draining cash that are not important. There may be contracts that are loss making. It may just be that the director is so focused on a bit of the business that doesn't really count, that he's lost sight of the bigger picture. Sometimes you've got to divest divisions, you've got to close down, or sometimes you've even got to get rid of unprofitable contracts and tell tell customers that they need to go somewhere else.
So it's interesting. We were talking just before about the concept that things like insolvency, at least my clients, let's say, would be scared stiff to go to an insolvency practitioner because it's got so many bad connotations. And actually, the first thing that a typical business owner within my space would do would they would pump in their own personal money into the business to try to save it. And I think that I mean, I would like to hear your opinion on that because I would imagine that's a big red flag. Is that right?
You've got to be very careful. Okay, where a business is being run and the owner sees that there are issues, it's all very well pumping in more money, but for what purpose? Okay, if your only solution is putting more cash in, but you don't fix the underlying issues, all that's going to happen is in the fullness of time you're going to lose the cash. So, give you an example. It's a very different scenario if every month the business is turning over £100,000, but the expenses are £120,000. In a situation like that, you can pump as much cash as you want, but eventually you're just going to run out of cash. And so, sometimes with your help, Robert, you could actually reduce um, you could reduce the overheads and make it profitable. But I normally caution directors against putting more cash in because that's very, very seldom is that the correct solution.
And that what happens is it turns into this crazy cycle where they'll borrow personal money in order to inject to the business, not trying to save it because they don't want to go. What they think of these scary words: liquidation, insolvency. And I think Michael was saying how it's not so bad. I'd love to hear from you what he said. It's actually quite positive. It's really not as bad. And just before I really want to hand over to hear more about it. But it's just like it's such a shame that business owners will be borrowing £500,000 of a particular business owner that I know of in order to inject into the business, which really, if they went down the liquidation route, they would have none of that, and then they wouldn't have no personal liability, nothing. And so I think there are other options out there that you're going to talk us through.
I think we got to you first of all, you're completely correct, but we got to go back to first principles. And first principles are, everything we as insolvency practitioners do is regulated by the 1986 Insolvency Act and the rules and what we call SIPs, which is effectively guidance from our regulators. We're very, very well regulated, very tightly regulated, and there are lots of rules around what we can't and can do. But the whole point is that, you know, the insolvency regime in the United Kingdom is what many countries see as a soft regime. It's not soft because it's weak. It's soft because it's designed to give a nation of traders a second chance. So there are processes involved to stop rogue traders, absolutely, criminals, absolutely. But for your normal director, where things have moved on beyond what he's capable or she's capable of dealing with, the Insolvency Act in the UK and the insolvency regime really goes out of its way to assist. And I think the first distinguishing feature that we've got to look at is the difference between a business and a company. So most people see a lot of directors are the shareholder, they're also the director, and they view the company as an extension of themselves. There's a fundamental error in that because the company is actually a separate legal person in that the company can sue or be sued, and it's different from the director. Now, the company is the corporate rep because you go to company's house and you register a company, but that normally wraps a business, and the business is where the value is. So it's almost like a knight with armor, where the business is the knight and the armor is the company.
I
Now,
mean, the business,
off,
it's just to interrupt you for a second to understand. I mean, the business is the underlying entity, and the company and company's house is just the wrapper, the name of what the business is called. Is that what you mean?
correct. It's a corporate structure, a legal person which owns the assets. Now, what's really important is that sometimes you will have an insolvent company, and it will be insolvent because either cash flow insolvent or balance sheet insolvent or both. But underlying that is a fundamentally nice business. A business that, if properly run, can develop and deliver substantial wealth and assets and generate substantial cash back to the shareholders. And what we would sometimes look to do is put that company into liquidation and save the business. So I'll give you a practical example of this. I recently had a restaurant been trading for many years, and due to circumstances beyond their control, they had a sharp drop in the number of customers. What happened is the council outside had dug up the pipes, and so the
Oh,
pavement was a building site for about a year and a half. Up and down the streets. So it messed with parking, it messed with the ability of people to come in. And as a result, over the year and a half, um, turnover dropped substantially. But of course, the business still had to pay its staff. It still had to buy the raw materials, the food. It still had to pay its rent, its non-domestic rates, its utilities. And so what happened is the business built up a mountain of debt, been successful for many years. And what we did there is not we, the accountants, set up a new company, and we valued the restaurant, the business, and it was valued on basis of how much cash it generates, the profitability, the asset value, because there were assets, there was kitchen equipment, etc. And what then happened was we placed the company into liquidation, and the new company that had been set up with the help of the accountant purchased the assets from me, the liquidator, and was able to carry on running in the same premises. We assigned the lease with the consent of the landlord. And what it meant is that they ditched the debt. The debt was left behind, and the viable, profitable, cash flow generative business was able to survive, even though it was in the name of a different company. Now, the question is, did the customers know? No. The only way they will know is because when they get the receipt at the top, it will have a different business name, different company name. Okay. Did the staff know? Didn't affect the staff because the staff were two-peed over to the new organization. What happened to the creditors? Part of the creditors' claims got paid from the proceeds of the sale, and other part of the proceeds of the sale came to pay our fees.
would you have to change the logo on the company of the restaurant?
No, no, you don't.
You need to put it on the receipt. Sounds like.
So there are very specific laws and rules against this. Effectively, there is a process whereby we can reuse the company name. It's a process, and you normally involve lawyers, but it is very possible. And often the cost of this is far less than it would cost to redo, all the signage, all the menus, all the cars if they've got cars or sign writing, etc. So yes, there's no issue with that.
So
No issue with
effectively,
that at all.
the main concerns that people have are one is, oh my goodness, I can't carry on trading. They're saying that's not true at all. It's just the wrapper we're taking away. The second
Correct.
concern is, even if I carry on trading, it'll be a completely different name and I'll lose faith with all my suppliers and my customers. That's not true either, because effectively we can get round any kind of significant changes from that respect. And the third concern is that my suppliers will not be happy with me because effectively, if I owe them money, then I've got out of paying them. How do we deal with that? I know that you said some of the money we pay through the proceeds.
Yes. So very often you will have long-standing suppliers, and they would have made profit many times more than the money that you owe them. And normally it's about open, honest communication where you say to them, look, guys, we can't afford to pay you. I don't have a choice. I've got to do this. And very often, the suppliers will say that, we understand. We take the hit. We've been supplying you for a long time, and we will continue supplying you going forward on a pro forma basis. Although I must say, occasionally suppliers will say, you know what, unfortunately, we're really upset. We're not going to supply you going forward. In which case, it's going to take time. You've got to find alternative suppliers, or you've got to build up a trading history. And over time, the suppliers will come back to you.
Right. Do you find that the suppliers eventually, do come back? It makes sense,
Business is tough. People have got short memories. Sometimes what happens is the suppliers say, look, we want cash on delivery. And they do that for a year or 2 years. And obviously, there are cash flow implications for the business, but eventually you will have a situation where they'd ease up and start giving credit again.
Yeah, I mean, I've got one client now, they've become insolvent and and I was working with them. I actually advised them to go to an IP, to go through liquidation. They've done that. They're reopening now in a new company, but because they realized how precarious the situation was and how risky, and they took out all different loans, they said, Robert, I want you to be involved. I want you to be involved from the very beginning to manage the cash flow, do all the reporting, all the management accounts we need to do. We need to be in control of our business growth. And that's exactly, I can imagine that, businesses gone into liquidation. They're very conscious of the fact they need to manage their cash flow. The suppliers will have the payment up front, but and they these guys are taking out more loans because they've run out of cash to restock, but they're doing it in a way which is very, very, very controlled, small, baby steps in order to kind of achieve a long term goal. Is that right? How
I,
long does
I
the
think,
well,
sorry, I think you raise a very important point. It's all about sustainability. There's nothing wrong with taking out credit, but you've got to know that you can repay. And you've got to be able to repay within the terms of the credit you're taking out. If you're taking out credit from a supplier and you need to pay them within 30 days, you need to pay them within that time. There's nothing worse than them advancing credit and then you can't pay them because then you're putting your new company at risk.
Right, it's a really important point. How long does the whole process take? I know that how long is a piece of string, I suppose, but is there any kind of timelines and how does it work?
So there are three elements to this. The first element is the time until the company goes into liquidation. And a lot of the time, this is dependent on the client themselves because there's a lot of information that we need prior to acting. The anti-money laundering stuff, the KYC stuff, the same stuff that lawyers and accountants need to get because we can't deal with someone unless we know who dealing with. So that's the first thing. And often clients are very, very slow to get us that information. The second thing we would need to know is the financial position. So we'd need 3 years of bank statements, typically. We'd need last 3 years financial accounts and management accounts up to date. Sometimes there are no management accounts, and that's absolutely fine. And then what happens is we start the pre-liquidation phase. We use the information they've given us and we write to the creditors, we put an advert in the London Gazette, and the company can go into liquidation within a couple of weeks, provided the accountant and the director give us the information quickly. Once the company is formally in liquidation, depending on what the circumstances are, if it's a very complex company and we've got to do a serious investigation, it can go on for years. But normally it would terminate within 12 months. So most liquidations are less than 12 months. And then what happens is the company 3 months after that would fall off at Companies House. It would be deregistered.
So that means you can have a scenario that you can have a company A. They might owe £1 million to different suppliers and HMRC and all sorts of things like that. And but effectively, fundamentally, they believe they're profitable, and they've got so they could say, do you know what I'm going to do? I'm going to do liquidation. That in a best case scenario, that might be all wound up within about 2 or 3 months, and they can reopen again. That £1 million of debt has now been totally goff in thin air, and they've reopened and they're current trading.
Yes, but there's a but. And the but is that we as liquidators are required to do an investigation into the circumstances leading to the insolvency. But not only that, within 3 months of our appointment, we have an obligation, a legal obligation, to put in a full report to the insolvency service regarding the conduct of the directors. So if it is found that the directors were negligent, or did things that were unlawful or illegal or criminal, or even not right. For example, they took deposits from clients and didn't deliver the goods. I had a wedding planner that did that. Then they have there's a chance that they will actually be banned as a director for anything between 2 and 14 years. Obviously, 14 years is the most serious. Now, people often say, oh, yeah, it's fine. My wife will carry on, or my husband will carry on, or my boyfriend. Okay, it doesn't work like that. If it's found that you're doing that sort of thing, it's a criminal offense, and there's a possibility of jail. If you defy a ban by trying to put somebody in as a stooge, you run the risk of both of you going to jail.
Okay, so that is the scary part.
Okay. Yeah, that
I,
is the scary part. And it must be scary because there must be a cost to things. Having said that, if it's a director that's run things absolutely cleanly, but due to circumstances finds himself in liquidation, that's not an issue. The other thing, of course, is depending on the conduct of the director, there may be things where the directors need to pay money in. And I'll give you an example. If you've got a director with an overdrawn director's loan account, in other words, they've borrowed money from the company, that would need to be repaid in the liquidation because it's an asset of the liquidation. Remember, the liquidator's got several jobs. The first is to do an investigation into the circumstances leading to the liquidation, the insolvency. The second is to see what assets can be recovered for the benefit of the creditors. And those could be from third parties, they could be from the directors. And it's not something that we say, oh, you know what, we're going to go for the directors and teach them a lesson. It's not meant to punish people. It's meant to, it's about justice and recovering what lawfully belongs to the company. Remembering, of course, that the company is a separate legal personality. The third thing is we look at the claims of the creditors, and we've got to make sure that the claims are proper, because in the past, it's come to our attention that sometimes people will try and inflate their claims to enrich themselves when they're not entitled to. In a circumstance like that, we will reject their claim. So that really is the role of a liquidator.
it makes a lot of sense. At the end of the day, you're giving people a golden ticket. You've got, they can wipe away all their debts. So the other side of the coin is, I'm giving you this kind of amazing opportunity here, but then it has to come with certain regulations. It makes perfect sense. Otherwise, people taking advantage. We've been speaking a
Yes.
lot about liquidation. Let's move on to briefly about there's another product that an IP would do. Called CVA. Is it really liquidation or CVA? Can you explain a bit more what is a CVA and what's the difference between that and
Okay.
liquidation?
Okay. So we have spoken about liquidations, and the form of liquidation that we've focused on is what we call a creditor voluntary liquidation, or a CVL. This is a process where the director initially chooses the liquidator, obviously subject to ratification by the creditors later on the process. I can go into that in due course, but it's an out of court process. A CVA is a company voluntary arrangement, and this is where the company owes creditors money, and effectively my job as well, I've got three distinct roles. The first is that of advisor, where I look at the company objectively and I try and understand the circumstances leading to the insolvency. And I also look at the options available. And then I need to, in my professional opinion, decide whether or not a company voluntary arrangement, or CVA, is going to give the best return to the creditors. And if I, as an insolvency practitioner believe that it will, then my role changes to that of nominee. As nominee, my job is to assist the directors in crafting their CVA proposal. I also do a nominee report saying whether or not I approve, and normally I would approve because otherwise I wouldn't be assisting them. And we put together a CVA proposal, and the CVA proposal has got several parts. It's got a historical part
What
talking
is it
about
on a very high level, firstly, and then we can break down into, and in one sentence, what is a CVA?
it's a contract between the company and its creditors,
That would do what?
and each of them agree to do certain things. So typically, the company would agree to make monthly contributions into the CVA for a period of time, but they're different types of CVAs, and the creditors are stopped from taking any enforcement action while the CVA is live.
So, from my understanding, is that the case that a liquidation is we wipe off the debt, whereas a CVA is we repay the debt, but in a very, very managed way. Is that right?
Correct. A liquidation is a terminal event. We effectively finish off the company and use the remaining assets to pay a dividend to creditors, whereas with the CVA, the directors remain in control of the company, subject to the CVA. My role as CVA supervisor is to check that the terms of the CVA agreed between the company and the creditors are adhered to by both sides, and to ensure that whatever the company said would be paid in gets paid in, and to make a distribution to the creditors in line with the CVA proposal.
So you kind of hold that money as an intermediary. The client would pay you, and then you would pay the suppliers as per the contract.
Correct. I hold the money in trust on behalf of the CVA creditors. Now, a CVA, there are typically two outcomes. Outcome one is the CVA is successfully completed, and so the creditors get the dividends that they were promised. Or sometimes a CVA won't be completed, and typically the typical reason for that is because the company fails to make the contributions into the CVA, and after a certain number, and it's all dependent on what we agree of these defaults, I've got no option but to issue a certificate of termination and to put the company into liquidation. So if a CVA fails, typically liquidation will follow.
Why would a company choose CVA if liquidation is just the wrapper and we can just get rid of all the debt? Why would you choose to keep the company but repay the suppliers?
There are many reasons for that. One of them is historical. Sometimes you get companies that have been passed through generations, and the current generation of directors believe it will be dishonorable, disloyal to terminate a company that was set up by their father or grandfather or great grandfather in some cases. Sometimes you have contracts that are very, very difficult to negotiate, and a terminal event will make it impossible for any successor company to be able to renegotiate a contract. For example, if you had a contract with one of the big supermarkets or one of the big IT companies, very, very difficult. Sometimes the directors take the view that they want to give it a shot. They really think that if we can box off the creditors within the CVA, there's enough cash flow to actually pay them off. And remember, of course, that a CVA doesn't have to pay 100p in the pound. You can propose a much lower. So I've done them as low as 25p in the pound. So sometimes there will be a substantial discount um, applied. Um, but generally, the other thing is CVAs only work where there's been a single event that has led to a buildup of creditors. Give you an example. Got a plumber. Um, plumber, plumber runs the business, falls, breaks his leg, and for 6 weeks can't work. Okay, he's working through a limited company. In that situation, he may not be able to shift the debt that's accrued over the 6 weeks. I mean, it's just an example, right? In which case, the CVA will enable him to pay that debt over a number of years or months or whatever is agreed without losing control of the company. The other thing, of course, is within a CVA, there is no investigation. So I'm not required to investigate what happened before. I'm just required to make sure that what the directors told me is true, and make sure that whatever's promised in the CVA proposal is carried out.
So it's almost like a legalistic mediation and such, between the company and the suppliers is much more. Also, one thing about that plumber example is really interesting. So, because I always imagine any kind of insolvency situation is the worst case, like the end of the road, and we have to do something. But the plumbing example, look, I lost out 6 weeks of income. What do I do about it? You know what? Let's go to Michael. He'll sort me out a CVA just to patch that hole while I get back on my feet. And that's a very short term feasible solution. It's a really good idea.
Correct. I mean, I've had I've done CVAs. There was a company that provided security for quite a high profile venue, and they discovered that their former accountant had committed fraud and stolen about £450,000 from them,
Oh my gosh,
um, and said that they were paying revenue but hadn't. And unfortunately, the accountant passed away, and it was only when the new accountant came in that they recognized that there was this issue. Now, that's something that it was a highly cash generative, highly profitable company, but they just were not making the kind of money to enable them to pay the money they owed revenue. But with a CV over 5 years, they could pay 20% of it a year quite comfortably.
fantastic. Okay, so we're kind of coming to the end now, I suppose. What are there any kind of key messages or lessons you want to take forward as us to summarize our discussion? It's been so interesting to hear about these all the different facets of what an IP does. Last lesson do you want to give everyone to take away?
I think the best advice I can give is to ask for advice early. The earlier a director asks for advice from either an IP, the accountant, or their lawyer, the more options available to us. If you bury your head in the sand, it will probably end up as a liquidation. I mean, we haven't touched on quite a few other things that we do. We haven't touched on administrations, for example. We haven't touched on compulsory liquidations, but the big one really is the CVL followed by the CVA. But the advice has got to be get advice early. Even if you don't follow the advice, understand your options.
And I think also just to add on to this point, yeah, 100%, because the people try to patch up themselves. They don't. They'll say, "I'll only need a professional." Let's say, "I need an accountant to submit my annual return. I need an IP when I need to go into liquidation. I need." They'll look at these people as like a, when I need to do this, then I'll do that. But if they did, like Mike was saying, if they did go early and just take advice, then it might be. I know someone, they literally went personally bankrupt. They had a very successful business, very, very profitable. There was a recession, it was a construction business, and the houses they built weren't selling. They injected loads and loads and loads of personal money, took loads of those out, and unfortunately, the company went bust, liquidated, and their personal situation also, they went bankrupt, and it was a terrible scenario. But all because, if they, who would have known? If they'd approached Michael earlier, then all of that would have been avoided. So it's a really important lesson learned.
Thank you, Robert. Yes, I think it is, and that's really the one thing that I say to people is, you know, come to me and say, look, I know that in 6 months' time I'm going to run out of cash. Okay, because then I've got options. Don't come to me and say 6 months ago. Well, do come to me, but don't come to me and say 6 months ago I ran out of cash, because then your options are very, very limited.
Brilliant. Okay, well, Michael, it's fantastic speaking to you. Thank you so much. Really, really interesting.
Thank
We'll
you, Robert.
put your
Appreciate it.
details below, and anyone who wants any questions, any advice, RG Insolvency, Michael Goldstein, and I'm sure he'll be happy to help.
Thank you, Robert. Really appreciate your time. Take care.
Take care.